The real estate market is heading toward a cliff, and 2026 could be the year everything changes. If you own property, plan to buy, or have investments tied to real estate, the next 3 minutes could save you from financial disaster. Stay with me, because what I'm about to reveal goes against everything mainstream media is telling you right now. The warning signs are everywhere, but most people aren't paying attention. Right now, as you watch this video, the foundations of the real estate market are cracking beneath our feet. Commercial real estate vacancies have hit levels we haven't seen since the 2008 financial crisis. Office buildings in major cities like San Francisco, New York, and Chicago are sitting empty, with occupancy rates plummeting below 60%. But here's what nobody's talking about. This isn't just about remote work changing office dynamics. This is about a fundamental shift in how our economy operates, and residential real estate is next in line. Let me walk you through exactly what's happening and why 2026 is the critical year. The Federal Reserve has been playing a dangerous game with interest rates, and the consequences are about to catch up with us. When rates skyrocketed from near 0 to over 7% for mortgages, it created a frozen market. Homeowners who locked in rates at 3% or lower refused to sell because buying another home would mean doubling or tripling their monthly payment. Meanwhile, potential buyers are priced out of the market entirely. This standoff can't last forever, and when it breaks, the results will be catastrophic for those who aren't prepared. The commercial real estate sector is the canary in the coal mine. Over $1.5 trillion in commercial real estate debt is coming due between now and 2026. Banks are already sitting on massive unrealized losses from commercial properties that have lost 30 to 40% of their value. Small and regional banks are particularly vulnerable because they hold a disproportionate amount of commercial real estate loans on their books. When these loans start defaulting, and they will, it's going to trigger a cascade effect that spreads into residential markets faster than most people think possible. Here's the mechanism that will connect commercial failures to your home's value. Banks that take losses on commercial properties will tighten lending standards dramatically. They'll require larger down payments, higher credit scores, and more income verification. This credit crunch will remove buyers from the market right when homeowners who've been holding out finally need to sell. Supply will surge while demand collapses, and that's the textbook definition of a price crash. We saw this exact pattern in 2008, but this time the commercial real estate component makes it potentially worse. The demographic trends are working against real estate stability too. Baby boomers, the wealthiest generation in history, are beginning to downsize and sell their large family homes in significant numbers. Millennials and Gen Z, who should be the natural buyers for these properties, are buried under student loan debt and can't afford the down payments even if they wanted to buy. This generational wealth transfer isn't happening through real estate purchases like it did in previous decades. Instead, younger generations are choosing to rent longer, invest in stocks and crypto, or simply delay homeownership indefinitely. This shift in cultural attitudes toward homeownership is permanent, not temporary. The insurance crisis is another factor that's flying under the radar, but will devastate property values in specific regions. Climate change, regardless of your political views on its causes, is making certain areas virtually uninsurable. Florida, California, and Gulf Coast states are seeing major insurers pull out entirely or raise premiums by 300% or more. When you can't insure a property affordably, you can't get a mortgage, and when you can't get a mortgage, the property becomes nearly worthless to most buyers. This insurance crisis will accelerate dramatically in 2026 as more insurers reassess their risk models and abandon high-risk markets. Property taxes are the silent killer that nobody wants to discuss. Municipalities across America are facing budget crises as commercial property tax revenues collapse. Empty office buildings and struggling retail centers generate far less tax revenue than they did 5 years ago. To make up the shortfall, cities and counties are shifting the tax burden onto residential property owners. Your property taxes could increase by 50 to 100% over the next few years, making home ownership unaffordable even for people who own their homes outright. This tax squeeze will force many retirees and fixed-income homeowners to sell, adding even more supply to an already oversaturated market. The perfect storm is forming, and 2026 is when all these factors converge simultaneously. Now let's talk about the specific timeline and why 2026 is the critical year you need to focus on. The Federal Reserve's rate hiking cycle, which began in 2022, typically takes 18 to 24 months to fully impact the real estate market. We're now entering the phase where the cumulative effects of sustained high rates are about to manifest in ways that will shock most homeowners and investors. The adjustable rate mortgages that people took out in 2021 and 2022, thinking rates would stay low forever, are resetting right now and through 2025. These ARM resets are forcing homeowners to either refinance at much higher rates or sell their properties, and most are choosing to sell. The commercial mortgage-backed securities market is showing stress fractures that mirror what we saw in the subprime mortgage crisis of 2007. CMBS delinquency rates have doubled in the past year and are accelerating. These securities are held by pension funds, insurance companies, and banks around the world. When these securities start failing, it creates a global financial contagion that spreads far beyond real estate. International investors, who have been major buyers of U.S. real estate for decades, are already pulling back. Chinese buyers, who were once the largest foreign purchaser group, have virtually disappeared from the market due to capital controls and their own domestic economic problems. The work-from-home revolution is permanent, and its full impact on real estate hasn't been priced in yet. Companies are realizing they can operate with 70% less office space than they had pre-pandemic. Leases signed in 2019 and 2020 are expiring now, and companies aren't renewing them. This creates a doom loop in downtown areas. Fewer office workers means less foot traffic, which kills retail businesses, which makes downtown less attractive, which causes more companies to leave. The residential properties in these downtown cores, particularly expensive condos that were built assuming vibrant urban centers, are going to lose value catastrophically. If you own property in a downtown area of a major city, 2026 is your last chance to sell before values crater. The construction pipeline is another ticking time bomb. Developers broke ground on hundreds of thousands of new housing units in 2022 and 2023, when they thought the market would remain hot forever. These projects take 2 to 3 years to complete, which means a massive wave of new supply is hitting the market right now and through 2026. This new supply is arriving precisely when demand is weakest, creating a supply glut that will depress prices across entire metropolitan areas. The developers who built these projects are already underwater on their construction loans, and many will be forced to sell at steep discounts just to avoid bankruptcy. Regional variations matter enormously in this crisis, and understanding which markets will be hit hardest is crucial for your survival strategy. Markets that experienced the biggest price increases during the pandemic boom are facing the largest corrections. Boise, Austin, Phoenix, and Las Vegas saw home prices increase by 50 to 80% between 2020 and 2022. These markets are already showing significant price declines, and by 2026, many properties will have given back all their pandemic gains and more. Conversely, markets that remained relatively stable during the boom, like Cleveland, Pittsburgh, and many Midwest cities, will experience much milder corrections because they never had the speculative excess to begin with. The rental market is about to flip from landlord-friendly to tenant-friendly in a dramatic reversal. Institutional investors like Blackstone and Invitation Homes bought tens of thousands of single-family homes to convert into rentals, driving up both purchase prices and rents. These companies are now sitting on properties that have declined in value, while their borrowing costs have increased substantially. They're starting to sell, and when institutional investors sell in bulk, it floods the market and crashes prices. Additionally, all those new apartment buildings I mentioned earlier are creating a rental supply glut. Rents are already falling in many markets, and by 2026, renters will have tremendous negotiating power. If you're a small landlord competing against desperate institutional sellers and brand new apartment complexes offering concessions, your rental property could become a money-losing proposition very quickly. The psychological component of market crashes is often underestimated, but absolutely critical to understand. Right now, most homeowners still believe their property values will recover or continue increasing because that's what's always happened in their lifetime experience. This belief keeps them holding on to properties even as warning signs multiply. But there's a tipping point in every market crash where sentiment shifts from hope to panic. Once your neighbors start selling at losses and local news starts running stories about foreclosures and price declines, the panic selling begins. This psychological shift typically happens very suddenly, and once it starts, it's almost impossible to sell at anything close to your desired price. The time to act is before the panic, not during it, and we're approaching that tipping point rapidly as we head into 2026. Let's discuss the specific strategies you need to implement right now to protect yourself and potentially profit from this coming crisis. The first and most important principle is liquidity. In a market crash, cash is king, and the people who survive and thrive are those who have accessible capital when everyone else is desperate. If you're currently sitting on significant home equity, you need to make a decision. Do you believe your property will maintain or increase its value through 2026 and beyond? Or would you be better off converting that equity into cash now? This isn't an easy decision, but it's one you must make consciously rather than by default. For those who decide to sell, timing is everything. The best time to sell was probably 2022, but the second best time is right now, before the 2026 crisis fully materializes. List your property immediately if you're in a vulnerable market or property type. Price it aggressively to sell quickly, rather than trying to squeeze out every last dollar. Remember, in a declining market, every month you wait costs you more than the small amount you might gain by holding out for a higher offer. Work with a real estate agent who understands market cycles and is not just going to tell you what you want to hear about your property's value. Get multiple comparative market analyses and price below the comps, not at or above them. If you're planning to buy real estate, patience is your greatest weapon. The absolute worst thing you can do right now is rush into a purchase because you're afraid of missing out or because you think rates might go higher. Rates might indeed go higher in the short term, but property prices are going to fall much more than any rate increase will cost you. It's better to pay 6% interest on a $300,000 home than 4% interest on a $500,000 home. The math is simple, but emotionally difficult for many buyers to accept. Wait until at least late 2026 or early 2027 before making any significant real estate purchases. The deals that will be available then will be extraordinary compared to today's market. For current homeowners who aren't planning to sell, your strategy should focus on reducing vulnerability and increasing financial flexibility. If you have an adjustable rate mortgage, refinance to a fixed rate immediately, even if it means paying a higher rate now. The certainty and stability of a fixed payment is worth the cost. Pay down high-interest debt aggressively, especially credit cards and home equity lines of credit. If the economy deteriorates as expected, credit will become much harder to access, and the credit you have now might be reduced or eliminated by lenders. Build an emergency fund that can cover at least 12 months of all housing expenses, including mortgage, taxes, insurance, and maintenance. Real estate investors face particularly complex decisions in this environment. If you own rental properties, you need to evaluate each one individually based on cash flow, location, and tenant quality. Properties that are cash flow positive, even in a worst-case scenario of lower rents and higher vacancy, can be held through the crisis. Properties that are marginally profitable or depend on appreciation for their returns should be sold immediately. Do not fall into the trap of holding on to bad investments because you do not want to realize a loss. The loss is already there whether you realize it or not, and holding on to a declining asset just makes the loss bigger. Be ruthless in your portfolio evaluation and willing to cut losses on properties that do not meet strict cash flow criteria. Diversification is crucial, but most people think about it wrong. Diversification does not mean owning properties in multiple cities if they're all subject to the same market forces. True diversification means having assets in different categories that respond differently to economic conditions. If you're heavily concentrated in real estate, you should be moving capital into assets that perform well during deflationary crashes. High-quality bonds, cash equivalents, and defensive stocks in sectors like utilities and consumer staples. Gold and other precious metals also serve as insurance against currency devaluation and financial system instability. The goal isn't to maximize returns right now. It's to preserve capital so you have ammunition when the crisis creates once-in-a-generation buying opportunities. Tax strategies become incredibly important in a declining real estate market. If you sell a property at a loss, you can use that capital loss to offset capital gains from other investments. If you're a real estate professional for tax purposes, you might be able to deduct rental real estate losses against your ordinary income. Consult with a CPA who specializes in real estate taxation to understand all your options. Additionally, if you're considering selling a primary residence, remember that you can exclude up to $250,000 of gain if you're single, or $500,000 if you're married, as long as you've lived in the home for 2 of the past 5 years. This exclusion is a powerful tax benefit that you should take advantage of before values decline and eliminate your gains entirely. Strategic tax planning can save you tens of thousands of dollars during this transition period. The banking sector's vulnerability is something every real estate owner needs to understand, because it directly affects your ability to access credit and the safety of your deposits. Regional banks, which provide the majority of commercial real estate loans and a significant portion of residential mortgages, are sitting on enormous unrealized losses. When Silicon Valley Bank and Signature Bank collapsed in 2023, it was a preview of what's coming on a larger scale. These banks failed primarily because they held long-term bonds and loans that lost value when interest rates increased. The same dynamic is affecting hundreds of other banks, but they haven't been forced to realize those losses yet because they're holding the assets to maturity. However, when commercial real estate loans start defaulting in significant numbers, banks will be forced to recognize losses, and some will fail. What does this mean for you practically? First, make sure your deposits are within FDIC insurance limits of $250,000 per depositor per bank. If you have more than that in any single institution, spread it across multiple banks immediately. Second, understand that even if your bank doesn't fail, it will likely tighten credit standards dramatically. Home equity lines of credit might be frozen or reduced. Getting a new mortgage or refinancing will become much more difficult and expensive. If you need to access credit for any reason, do it now before the crisis intensifies. Third, be prepared for the possibility that your mortgage servicer could change if your loan is sold to another institution. This is common during banking stress periods and usually doesn't affect your loan terms, but it can be confusing and create administrative headaches. The government's response to the coming real estate crisis is predictable but important to understand for planning purposes. Politicians will face enormous pressure to do something as homeowners and banks struggle. We'll likely see some combination of mortgage forbearance programs, first-time homebuyer subsidies, and possibly even direct government purchases of distressed properties. These programs might provide temporary relief, but they also tend to prolong the adjustment process and prevent prices from reaching true market clearing levels. Japan's experience with propping up its real estate market after their bubble burst in the 1990s should be instructive. They had decades of stagnation rather than a sharp crash and recovery. Don't count on government programs to save you, but be aware of them and use them tactically if they benefit your specific situation. International factors are playing a much larger role in U.S. real estate markets than most people realize. Chinese capital flight, which drove luxury property prices in cities like Vancouver, San Francisco, and New York to absurd levels, has essentially stopped due to Chinese government capital controls. Russian oligarch money, which was another major source of luxury real estate demand, has been sanctioned and frozen. Middle Eastern sovereign wealth funds are pulling back from U.S. real estate investments as oil revenues decline and domestic needs increase. This withdrawal of international capital removes a significant source of demand that isn't coming back anytime soon. If you own luxury property in a gateway city that was popular with international buyers, you're facing a particularly difficult market because your buyer pool has shrunk dramatically. The legal and regulatory environment is shifting in ways that will affect real estate values and ownership rights. Rent control is spreading to more cities and states as politicians respond to housing affordability crises. While rent control might seem like a tenant-friendly policy, it actually reduces the value of rental properties and discourages new construction, making housing shortages worse in the long run. If you own rental property in an area considering rent control legislation, factor that risk into your hold or sell decision. Environmental regulations are also becoming stricter, with some jurisdictions requiring expensive energy efficiency upgrades before properties can be sold. These compliance costs can easily run into tens of thousands of dollars and should be anticipated if you're planning to sell in the next few years. The insurance situation deserves deeper examination because it's creating a two-tier real estate market that most people don't understand yet. Properties that can be insured affordably will maintain much more value than properties where insurance is prohibitively expensive or unavailable. Florida is the most dramatic example. Homeowners insurance rates have increased by 200 to 400% in just 3 years, and major insurers like State Farm and Farmers have stopped writing new policies entirely. The state-backed insurer of last resort, Citizens Property Insurance, is overwhelmed and charging rates that make homeownership unaffordable for many. This insurance crisis is spreading to California wildfire zones, Louisiana hurricane areas, and anywhere else climate risks are increasing. Before you buy any property, research the insurance situation thoroughly and get actual quotes, not estimates. A house that seems affordable based on the mortgage payment alone might be completely unaffordable once you add in realistic insurance costs. The technological disruption of real estate is accelerating and will create winners and losers that might surprise you. Remote work technology has permanently changed location value calculations. Properties in expensive coastal cities that were valuable because they were near high-paying jobs are losing their premium as those jobs can now be done from anywhere. Meanwhile, properties in lower-cost areas with good quality of life are gaining value as remote workers relocate. This trend will continue and accelerate, creating opportunities in unexpected places. Additionally, the rise of short-term rental platforms like Airbnb has changed the economics of vacation property ownership, but regulatory backlash is now limiting or banning short-term rentals in many popular destinations. If you own a property that depends on short-term rental income, be aware that your business model might be regulated out of existence, destroying your property's value proposition overnight. Let's talk about specific property types and how they'll be affected differently by the 2026 crisis. Single-family homes in suburban areas with good schools will generally hold value better than other property types because they appeal to families with children, who are the most stable buyer demographic. However, even these properties will experience price declines in overheated markets. The key is affordability. If median home prices in your area are more than 4 times median household income, significant correction is likely. Historically, the long-term average is about 3 to 3.5 times income, and markets tend to revert to that mean eventually. Calculate this ratio for your specific market to gauge vulnerability. Condominiums and townhouses are particularly vulnerable in this crisis for several reasons. First, they often appeal to first-time buyers who are most sensitive to interest rate increases and economic uncertainty. Second, many condo buildings have homeowners association fees that have been increasing rapidly due to inflation in maintenance and insurance costs. These HOA fees make the total cost of ownership much higher than the mortgage payment alone, pricing out buyers. Third, older condo buildings are facing special assessments for major repairs and upgrades, sometimes running into tens of thousands of dollars per unit. If you own a condo, especially in a building more than 20 years old, be prepared for potentially massive special assessments and understand that these will destroy your property's resale value. Buyers are becoming much more sophisticated about evaluating condo building finances and will avoid buildings with deferred maintenance or inadequate reserves. Luxury properties above $1 million are in their own category of trouble. The luxury market is always more volatile than the overall market because it depends on discretionary buyers who can choose to wait. During the 2008 crisis, luxury properties declined by 40 to 60% in many markets, while median-priced homes fell by 20 to 30%. We're seeing early signs of the same pattern now. Luxury listings are sitting on the market for months with no offers, and sellers are being forced to make dramatic price cuts. If you own a luxury property, understand that your buyer pool is tiny and getting smaller. The wealthy individuals who could afford your property are watching the market carefully and know that waiting will get them a better deal. Price your property at least 20% below recent comparable sales if you need to sell, and be prepared to go even lower. Investment properties and second homes face unique challenges because they're not protected by the same emotional attachment and necessity that primary residences have. When people face financial stress, they sell their investment properties and second homes first. This means these property types will see more forced selling and steeper price declines than primary residences. Additionally, the tax advantages of investment properties are being reduced by recent legislation and IRS rule changes. The qualified business income deduction is being phased out for higher earners, and depreciation recapture rules are being enforced more strictly. If you own investment properties, model your after-tax returns carefully and honestly. Many properties that seemed profitable on paper are actually losing money when you account for all costs, taxes, and opportunity costs. Be willing to sell properties that don't meet your return requirements, even if it means realizing a loss. New construction homes are in a particularly interesting position. Builders are facing a dilemma. They have high land and construction costs from the past few years, but they need to compete with existing home inventory that's priced lower. Many builders are offering significant incentives like mortgage rate buydowns, free upgrades, and closing cost assistance. These incentives can make new construction more attractive than existing homes in some cases. However, be cautious about buying new construction in large master-planned communities where hundreds or thousands of homes are being built simultaneously. These communities can experience severe oversupply, and when the builder finally leaves, property values often decline as the supply glut becomes apparent. If you're considering new construction, focus on smaller infill developments in established neighborhoods rather than massive new communities on the urban fringe. Rural and recreational properties are a mixed bag. Some rural areas are benefiting from the remote work trend as people seek more space and lower costs. However, many rural properties are extremely illiquid, meaning they can take years to sell even in good markets. In a crisis, rural properties can become essentially unsellable at any reasonable price. If you own rural land or a recreational property, be realistic about its value and marketability. These properties should be viewed as lifestyle choices rather than investments, and you should be prepared to hold them indefinitely or sell at a significant loss if you need liquidity. The exception is rural properties within reasonable commuting distance of growing job centers, which can maintain value as people seek affordable housing options. Commercial properties deserve special attention because they're at the epicenter of this crisis. Office buildings, retail centers, and hotels are all facing existential challenges. Office buildings in particular are experiencing a complete revaluation as remote work becomes permanent. A building that was worth $50 million in 2019 might be worth $20 million today, and that's if you can find a buyer at all. Some office buildings are being converted to residential use, but this is expensive and only works for certain building types in certain locations. If you own any commercial real estate, you need to be talking to your lenders now about restructuring debt before you're in default. Many lenders are willing to work with borrowers proactively, but become much less flexible once you've missed payments. The workout options include extending loan terms, reducing interest rates temporarily, or even accepting a deed in lieu of foreclosure if the property is truly underwater. Now let's discuss the psychological and emotional aspects of navigating a real estate crisis, because these are often more important than the financial calculations. Real estate is deeply emotional for most people because it's tied to concepts of home, security, and identity. Your house isn't just an asset on a balance sheet, it's where you've built memories, raised children, and invested your dreams. This emotional attachment makes rational decision-making incredibly difficult. You need to recognize this emotional component and actively work to separate it from your financial decisions. Get advice from people who aren't emotionally invested in your property and can give you objective perspective. The sunk cost fallacy is particularly dangerous in real estate. This is the tendency to continue investing in something because you've already invested so much, even when continuing doesn't make rational sense. If you bought a property at the peak and it's now worth less than you paid, that loss already exists, whether you sell or not. Holding on to the property doesn't make the loss go away. It just delays recognizing it and potentially makes it worse. The money you've already spent is gone regardless of what you do next. The only question that matters is, given where you are today, what's the best decision going forward? Don't let past decisions that you can't change dictate future decisions that you can control. Social pressure and comparison are powerful forces that can lead you to make bad decisions. When all your friends and neighbors are talking about their home values and real estate investments, it's hard to be the one person saying you're worried about a crash. You might feel foolish or pessimistic, but remember that crowds are often wrong at critical turning points. The best time to sell is when everyone else is optimistic and buying, and the best time to buy is when everyone else is pessimistic and selling. If you wait until your social circle validates your concerns, it will be too late to act effectively. Have the courage to trust your analysis even when it goes against the consensus. Loss aversion is a cognitive bias where people feel the pain of losses more intensely than the pleasure of equivalent gains. This causes people to take irrational risks to avoid realizing losses. For example, someone might refuse to sell a property at a 10% loss, hoping it will recover, even when all evidence suggests further declines are likely. They are so focused on avoiding the pain of realizing that 10% loss that they end up suffering a 30 or 40% loss instead. Recognize this bias in yourself and consciously counteract it. Sometimes the smart move is to take a small loss now to avoid a much larger loss later. Think of it as paying an insurance premium to protect yourself from catastrophic outcomes. The planning fallacy is another cognitive trap where people underestimate how long things will take and how much they'll cost. In real estate, this manifests as believing you can time the market perfectly or that you'll be able to sell quickly when you need to. The reality is that real estate is illiquid and unpredictable. It can take 6 months or more to sell a property even in good markets, and in bad markets it can take years. Don't assume you'll be able to execute your exit strategy quickly or easily. Build in large margins of safety and assume things will take longer and cost more than you expect. This conservative planning will protect you from being forced into desperate decisions when your optimistic timeline does not work out. Confirmation bias is the tendency to seek out information that confirms what you already believe and ignore information that contradicts it. If you want to believe your property will maintain its value, you'll find plenty of articles and experts saying the market will be fine. If you're worried about a crash, you'll find plenty of doom and gloom predictions. The key is to actively seek out perspectives that challenge your assumptions. If you're optimistic, force yourself to read bearish analyses and consider their arguments seriously. If you're pessimistic, study the bull case and understand where you might be wrong. The truth is usually somewhere in the middle, and the best decisions come from considering all perspectives, rather than just the ones that feel comfortable. Stress and anxiety are inevitable when dealing with major financial decisions during uncertain times. Acknowledge these feelings rather than trying to suppress them. Talk to friends, family, or a therapist about your concerns. Exercise, meditation, and other stress management techniques become even more important during crisis periods. Make sure you're getting enough sleep, because sleep deprivation severely impairs decision-making ability. Don't make major decisions when you're in a highly emotional state. If you're feeling panicked or euphoric, wait until you've calmed down before taking action. Some of the worst financial decisions in history were made by people who were sleep-deprived, stressed, and reacting emotionally rather than thinking clearly. Take care of your mental and physical health so you can make the best decisions possible during this challenging period. Let's conclude with a comprehensive action plan that synthesizes everything we've discussed into concrete steps you can take immediately. First, conduct a thorough financial inventory of your entire situation. List all your assets, liabilities, income sources, and expenses. Calculate your net worth and your liquidity ratio, which is your liquid assets divided by your monthly expenses. If this ratio is below 12, meaning you couldn't cover a year of expenses with liquid assets, you're in a vulnerable position and need to build cash reserves urgently. Identify which assets you could sell quickly if needed and which are illiquid. This inventory will form the foundation of your crisis preparation strategy. Second, evaluate each real estate property you own individually using strict criteria. For each property, calculate the all-in cost of ownership including mortgage, taxes, insurance, maintenance, and opportunity cost of your equity. Compare this to what you could rent an equivalent property for. If ownership costs significantly more than renting, you're making an emotional decision rather than a financial one, which might be fine for a primary residence, but is dangerous for investment properties. For investment properties, calculate your actual cash-on-cash return and compare it to what you could earn in safer investments. Be brutally honest in these calculations and include all costs, not just the ones that are easy to measure. Based on this analysis, create a prioritized list of properties to sell, starting with the most vulnerable or lowest returning assets. Third, stress test your financial situation against worst-case scenarios. What happens if property values decline by 30%? What if you lose your job for 6 months? What if interest rates on your adjustable debts increase by 3%? What if rental income decreases by 20% due to higher vacancies? Model these scenarios specifically and quantitatively rather than just worrying about them abstractly. If any of these scenarios would cause you serious financial distress, you need to take action now to reduce your vulnerability. This might mean selling properties, paying down debt, building larger cash reserves, or diversifying income sources. The time to prepare for worst-case scenarios is before they happen, not during them. Fourth, develop relationships with professionals who can help you navigate this crisis. You need a real estate agent who understands market cycles and can give you honest advice about pricing and timing. You need a CPA who specializes in real estate taxation and can help you minimize tax consequences of selling or restructuring. You need a financial advisor who can help you rebalance your overall portfolio and isn't just trying to sell you products. You might need a real estate attorney if you're dealing with complex transactions or distressed properties. Build these relationships now, before you're in crisis mode and need help urgently. The best professionals are busy and selective about their clients, so establishing relationships early gives you access to better advice when you need it most. Fifth, create a detailed timeline and action plan for the next 18 months. Break down your strategy into specific actions with deadlines. For example, by January 2026, list investment property for sale. By March 2026, refinance primary residence to fixed rate. By June 2026, build emergency fund to 12 months of expenses. By September 2026, rebalance investment portfolio to 50% cash and bonds. Having a written plan with specific deadlines makes it much more likely you'll actually execute, rather than just worrying and procrastinating. Review and update this plan monthly as market conditions evolve. Be flexible and willing to adjust your timeline based on new information, but don't abandon the plan entirely just because conditions change. Sixth, educate yourself continuously about real estate markets, economics, and financial planning. Read books about previous real estate crises like the 2008 crash, the savings and loan crisis of the 1980s, and the Great Depression. Understanding how previous crises unfolded will help you recognize patterns and avoid common mistakes. Follow reputable real estate and economic analysts who have track records of accurate predictions. Be skeptical of anyone who claims to know exactly what will happen, because nobody does. But learn from people who think probabilistically and consider multiple scenarios. The more you understand about how markets work, the better decisions you'll make and the less anxious you'll feel about uncertainty. Finally, remember that every crisis creates opportunities for those who are prepared. The people who will thrive coming out of the 2026 real estate crisis are those who preserve capital now, stay liquid, and have the courage to buy when everyone else is panicking and selling. Real estate will eventually recover, as it always has, and the properties you'll be able to buy in 2027 and 2028 at distressed prices will generate wealth for decades to come. But you can only take advantage of those opportunities if you survive the crisis first. Don't be so focused on trying to squeeze out the last bit of profit from today's market that you end up trapped and unable to act when the real opportunities appear. Position yourself to be a buyer in the crisis, not a desperate seller, and you'll look back on this period as one of the best financial opportunities of your lifetime. The 2026 real estate crisis is coming whether we like it or not. The warning signs are clear for anyone willing to look at them honestly. But knowledge is power. And now you have the information and strategies you need to not just survive, but potentially thrive during this challenging period. Take action today. Don't wait until the crisis is obvious to everyone, because by then it will be too late to protect yourself effectively. If you found this video valuable, please like, subscribe, and share it with anyone who might benefit from this information. Drop a comment below telling me what actions you're taking to prepare, and let's continue this conversation. Your financial future depends on the decisions you make right now. Choose wisely, act decisively, and I'll see you in the next video.